Welcome everyone to the quarterly tax update for October to December 2017 from SRJ Walker Wayland. I'm Charlene Ryan and today I'll be going through the tax updates. I'm a senior manager with SRJ. Here's a bit of background information about myself and hopefully we can cover off on the key issues for the last quarter. So essentially the biggest change for the last quarter is the introduction of the Enterprise Plan Base Rate Entities Bill for 2017, which the government has now finally agreed on the legislation for that, which will lower and restrict access to the lower company tax rate from the 2018 income year onwards. The bill limits access to the 27.5% company tax rate by replacing the existing carrying on a business test with the passive income test. Essentially, under the new rules, the company won't be able to access the reduced company tax rate if more than 80% of its assessable income is passive in nature. So essentially the good news is, unlike the exposure draft, the amending legislation is not going to be retrospective and it will actually apply from the 2018 income year, which is great news for everybody having to consider retrospective possibility changes to tax rates, franking percentages and other items for the 2017 year. Removing the carrying on a business test also reduces some of the uncertainty that was currently in place around different types of entities having access to the lower rate. It's actually another change for us practitioners to get across, however, because there will be an extra test that adds a layer of complexity when we're determining what tax rates are going to apply. It essentially means that we have to analyse the components of turnover for a company. This is more relevant when a company receives income from trust distributions or partnerships. We're going to have to trace through those income multiple levels. For example, if Trust 1 distributes Trust 2 and then distributes into what some people like to call a corporate beneficiary or a bucket company or dump company, whether the dividends actually coming through here are treated as passive will also depend on shareholding percentages as well. Essentially, companies that own rental properties will not be considered for the lower tax rates, even though if those rental activities constitute carrying on a business. So under the new proposed rules, it won't be necessary to determine whether the company actually carries on a business in its own right under the ordinary principles, but it's still relevant as to whether the company can access the lower corporate tax rate for the 2017 year, which is very important to remember. Moving on, obviously the Housing Integrity Bill has been passed after announcements in the 17-18 budget. From 1 July 2017, there will no longer be deductions for travel expenses incurred in relation to deriving income from a rental property. So this includes flights to and from the property to inspect the property, or even people who've used vehicle cents per kilometre methods to visit rental properties. It also prevents taxpayers from claiming depreciation deductions on certain assets from 1 July 2017. An exposure draft. Further to this, an exposure draft has been released in relation to the proposed increase of capital gains tax discount percentages for people who invest in affordable housing in Australia. This could potentially mean that your discount for capital gains can go from 50% to 60%. In the 17-18 federal budget, the government announced a series of measures intended to improve housing affordability in Australia. They've released an exposure draft in relation to the proposed increase in the capital gains discount percentage for people who invest in affordable housing. Affordable housing can potentially qualify for an additional capital gains discount up to 10%. So therefore the total for people could go from the current 50% to 60% as a maximum. It will essentially only be available if the house has been used for affordable housing for at least 3 years after 1 January 2018. But a good thing is the 3 years don't have to be continuous. The additional discount does need to be apportioned if the individual was a non-resident or temporary resident, or when the property was not used to provide affordable housing during its ownership period. Essentially, individuals can access the additional 10% discount even if it's distributed by certain trusts, so managed investment trusts, where the gain is attributable to dwellings that have been used to provide affordable housing. The draft legislation at the moment sets out a number of conditions that need to be met in order to demonstrate the dwelling actually has been used for affordable housing, so it's a bit of a wait and watch this space on this one. Continuing on with property, there's now going to be a proposed change to how GST is applied to certain property transactions. Treasury has released an exposure draft that relates to these proposed changes, and it provides further details on how the new rules might operate. Essentially, when an entity makes taxable supply of new residential premises or vacant land, at the moment, they need to remit the appropriate GST to the ATO on their activity statements. However, the government is actually concerned at the moment about the level of non-compliance in the property industry, given the developers at the moment and the industry, and how some of them will actually wind up their businesses before the relevant business activity statement lodgement, and therefore avoiding paying the GST that is actually owed to the ATO. Under the new rules, the purchaser would be responsible for paying 1/11 of the purchase price to the ATO when they acquire the new residential premises or new subdivisions of residential land. They would probably need to pay this amount to the ATO on or before settlement. Then the developer would be entitled to claim a credit for the GST amount that has been applied to the ATO under these provisions. Further to this, if the developer is eligible for the GST margin scheme on the transaction, they would generally receive an additional refund from the ATO for any excess that's been paid during this period. The developer will also be responsible for notifying the purchaser of the application of the provisions and the requirement to withhold some of the purchase price and pay it to the ATO. Penalties will therefore apply if the notification process isn't actually provided or adhered to by the applicable deadlines. This is in line with the relatively new CGT foreign resident withholding rules, where the purchaser is responsible for paying amounts to the ATO at the time the transaction occurs. It also means that lawyers, conveyancers and accountants and real estate agents are going to have to work closely with their clients on both sides of the transaction to ensure that these new obligations are actually going to be met. Continuing on the property topic, on the ATO is now a guide which details various tax issues associated with property transactions. One of the topics that they are actually looking at the moment that hasn't really had a lot of exposure recently and in the past is where someone buys a property with the intention of carrying out renovations, living in it and then selling it once the work is complete, which is commonly termed property flipping. This is becoming more and more popular at the moment, especially with reality TV shows showing how easy it is to make a profit for people who choose these options. Many people actually make the assumption that a capital gain from this kind of activity will be exempt from tax because the property has been their main residence and they've lived in the property. However, this isn't actually the only case where property can be held on capital account. The ATO guide actually indicates that someone who is renovating a property with the intention of selling a gain for profit could still be taxed on revenue account in that case the main residence exemption is no longer applicable. The ATO is actually given 3 scenarios where they believe that they will treat it on either revenue or capital account. Obviously, the first one being a personal property investor. Someone purchases the property with the intent of using it as a long-term rental. Therefore, they might do some renovation activities and then sell the property earlier than what they actually thought they would. Generally, this would be considered on capital account, and depending on the circumstances, the main residence or the CGT discount exemptions could apply. The second scenario the ATO provides is an isolated profit-making undertaking. This is where someone actually buys a property with the intent of carrying out a renovation activity and selling the property when the work is complete. Generally speaking, the ATO will consider this on revenue account, and there will be no access to the main residence exemption or any CGT discounts. Finally, the obvious one, you're in the business of renovating properties. Essentially, you're doing property flipping activities on a regular or repetitive basis, and they're organised in a business-like manner. So therefore, generally the ATO will consider this on revenue account, and no access will apply to the main residence exemption or CGT discounts. What the ATO is trying to say is just because you live in the property for all or part of the ownership doesn't automatically mean that any profits on sale are going to be exempt from tax under the main residence exemption. So it's something to watch out for. Following on from that, there's payments to taxi licence holders. The ATO has actually released updated guidelines on income tax and GST treatment of payments made by the state governments in relation to taxi and hire car licences. Generally speaking, the ATO's view is that industry assistance payments made to taxi licence holders are ordinary income and will be taxed on revenue account, rather than being subject to the capital gains provisions. However, GST generally won't apply to these payments. Recently, the state government has decided to make some payments to taxi licence holders to help them offset impact of new regimes and help them compete under the new industry arrangements and against competitors like Uber and that sort of thing, or ride sharing. So essentially a one-off payment in some cases is being made, like a hardship or income support payment. And the ATO's view is that the payments should be taxed on a revenue account if it is made actually to assist a business to continue operating or to compensate for a loss of income. On the other hand, if the licence holder has permanently and completely exited the industry and has evidence to prove that that is actually the case at the time they've received the payment, there is a possibility that it can be on capital account, and the CGT calculation that applies to the surrender or disposal of the licence can be prepared. In situations where the passenger movement levies have been imposed, taxi operators need to include any fees and charges to passengers in their assessable income, but they can claim a deduction for the fee that's charged by the network. GST doesn't generally apply to the levy. However, if you pass it on to passengers, it's regarded as an increase in the price of your supply, and therefore GST will generally apply. Further to this, there's a lot of issues that need to be considered when we're talking about car expenses and ride sourcing and deductions that can be claimed for these types of activities. Generally speaking, as with any car expense, they need to be made using either the cents per kilometre method or the logbook method. The cents per kilometre method is obviously used up to 5,000 kilometres for each car per year. And the ATO has indicated that while you don't need to keep specific evidence of all your kilometres, you may be asked to show how you've actually calculated this at some point, whether that be diary records or travel information. The ATO has also provided some examples where travel can be treated as deductible when you're undertaking ride sourcing activities. So essentially, if someone's actually on their way to a private function or non-business related event, they can actually treat the travel as work-related if they accept a ride-sharing job on the way. But obviously it's only the kilometres travelled when driving to collect the passenger and therefore taking them to their destination, not the overall trip. However, on the flip side, there's an example of where someone who leaves home solely for the purpose of looking for work, then the travel can be deductible even if they actually don't provide any ride sourcing services in the end. It's because of the intent to go out and look for work and then travel home. If the intention changes before they go home, for example, they go out to a friend's place or a barbecue, then obviously that portion of travel is not deducted for work-related purposes. Following on, taxi travel and FBT. Section 58Z of the FBT Act contains specific exemptions for benefits relating to taxi travel when it's undertaken by your employees, obviously to and from work, or whether travel is actually due to the illness of the employee and they may be returning home. The ATO has indicated that the exemption doesn't actually extend to ride sourcing services provided in a vehicle that's not licensed to operate as a taxi, for example, Uber. The ATO is revisiting this interpretation in light of the federal court decision in the Uber case, which held that UberX drivers were actually providing taxi travel for GST purposes, as well as further developments in the state and territories in connection to these taxi licensing regulations. The ATO is considering updating its approach and adopting an interpretation that will include ride sourcing vehicles and other vehicles for hire, but they've decided to seek comments from interested parties before reaching a final view. The final date for comments for this was the 24th of October last year, so watch this space. Well, we all know there's a massive rise in digital currency and GST, and Bitcoin is the word of the moment. So following on from the announcement made in the 17-18 budget, the government has actually now introduced legislation that ensures supplies of digital currency are no longer subject to GST. These changes are expected to apply to supplies made on or after 1 July 2017. Essentially, they're just going to treat digital currency in much the same way as money is treated presently. This is being done to remove any double taxation that can arise when a digital currency is used to pay for goods or services. And while supplies of digital currency will generally be disregarded for GST, a transaction will still be recognised in the GST system if the digital currency is exchanged for other money or digital currency. And this may essentially trigger a supply or acquisition under the GST system, but it still could be treated as input taxed financial supply. And the government intends to amend the GST regulations to provide equivalent treatment for digital currencies. So the taxable payment reporting rules have obviously been quite successful for the government in the building and construction industry. Following recommendations made by the Black Economy Task Force, the government is now announcing that the system will essentially be expanded to include courier and cleaning services. They've released draft legislation relating to the expansion of the system, and the ATO has released guidance indicating how the new rules will be administered. It will essentially, entities that supply courier services or cleaning services will now be required to report to the ATO the details of payments made to other entities that relate wholly or partly to courier or cleaning services. The aim is to obviously capture the details of these payments made to contractors. Payments to employees are obviously excluded from these rules because the business is obviously already withholding, pay-as-you-go withholding in the system. The draft ATO guidance says that an entity only needs to report payments if it has an ABN. Payments to sole traders, companies, partnerships and trusts can also be captured under these rules. The rules for these payments will be for those made after 1 July 2018, and the first report will actually be due by the 28th of August 2019. Speaking of claims being under scrutiny, R&D claims are now under further increased scrutiny also. The Minister for Revenue and Financial Services has issued a media release referring to the succession prosecution of a tax agent who's been sentenced to 29 months imprisonment for his involvement in a scheme relating to R&D tax incentive claims. The ATO has indicated it will be increasing its focus on claims made under the R&D tax incentive, and there is a serious financial crime task force that have also become involved to seek and identify serious abuse of the R&D system. Essentially, any practitioners and clients who are seeking to access the R&D tax offsets not only need to ensure that they meet the basic eligibility criteria, but that appropriate documentation is produced and kept on file to support any claims that actually are made. There's a practice guidance 2016-16 on fixed entitlements and fixed trust. At a practical level, it's difficult for a trust to be classified as a fixed trust for tax purposes unless the Commissioner actually exercises his discretion. It's especially relevant when you're actually looking at the trust loss tests. So the ATO has actually issued the PCG to try and address this issue and remove some of the uncertainty that arises when determining whether a trust actually is a fixed trust. There's a safe harbour compliance approach, which means that it's actually possible to manage a trust tax affairs as if the Commissioner has actually exercised his discretion to treat the trust as a fixed trust, as long as these conditions are met. It is important to recognise, however, that even if you meet the safe harbour conditions, it can't necessarily be relied upon when you're applying the arm's length income rules for superannuation funds or the holding period rules when beneficiaries are seeking to claim franking credits flowing through the trust. There's been a new tax determination released 2017-21 and 2017-22. It's the application of the non-portfolio dividend exemption rules when dividends essentially are paid by a foreign company and they have to pass through a partnership or trust rather than actually being paid directly to an Australian company. Essentially, it ensures that dividends paid by these foreign companies to Australian resident companies are non-assessable, non-exempt income, as long as the Australian company holds participation interests in the foreign entity of at least 10%. The rules actually allow the exemption to apply where the 10% interest is held directly or indirectly in one or more interposed entities. The final TDs explain how the indirect tracing rules actually operate, and the ATO has confirmed that the tracing rules cannot generally apply when the dividends are received by a discretionary trust, even if they are subsequently distributed to a corporate beneficiary. So this is a really important thing to note. So there's some early stage investor tax incentives coming out. It's part of the government's National Innovation and Science Agenda, and it's basically been introduced to support and encourage investment in innovative Australian businesses. Under some of these incentive programs, investments in companies that have finance or insurance activities as their predominant activities don't actually qualify for these incentives. There is an exposure draft that may remove some of the restrictions that currently apply under the venture capital investment tax concessions, and this ensures that investments in fintech companies could actually qualify for the concessions if the basic conditions are met. The government is also planning to make a number of amendments to early stage venture capital limited partnership rules and the rules dealing with the early stage investor tax offset provisions. They're generally minor amendments that are aimed at ensuring the concessions apply as they were originally intended. Finally, moving on to the superannuation space. So, event-based reporting for all funds will come into and has come into effect on 1 July 2017. While the funds are actually not required to report events until 1 July 2018, they actually do need to backdate and report events from 1 July 2017. The Transfer Balance Account Report, or TBAR as it's been otherwise coined, has now been released by the ATO to capture these events. Events that are to be reported on the TBAR include super income streams in existence just before 1 July 2017, and any of the following events that occur post 1 July 2017. Superannuation income streams that have commenced retirement phase, limited recourse borrowing arrangement payments, member commutations, compliance with a commutation authority issued by the Commissioner, personal injury contributions, super income streams that stop being in retirement phase. Essentially, the forms released by the ATO are going to frustrate practitioners, as you can only report one event at a time. So therefore, if you have funds with multiple reporting events, it's going to be tedious. Electronic reporting is also not available until January 2018. It's all going to be paper-based. And finally, the Fair Work Amendment Recovering Unpaid Super Bill for 2017 has actually been introduced to Parliament, and it has a number of fundamental changes to the superannuation guarantee system. These changes will be expected to be applied from 1 July 2018 if this is passed. The first change is actually designed to improve the ability of employees to recover unpaid super guarantee amounts by bringing superannuation contributions within the national employment standards. So the Fair Work Ombudsman would be able to take steps to recover unpaid super amounts, but also to provide employees with a direct legal avenue to recover these amounts, rather than hoping that the ATO can actually do this on their behalf. The ATO has released a webinar that explores the significant changes to this system, and it's been made, and of those that have been made and those that are coming, and the common problems and solutions. So some of the other key changes proposed are that employers are required to notify employees when super contributions have been made. Essentially, the thought process is this will occur via payslips. Ensuring amounts that are contributed by way of salary sacrifice are actually not treated as employer contributions, and removing the current super guarantee exemption for situations where an employee is paid less than $450 in a particular month. So they're just some of the changes going through. Basically, that is our tax update for this quarter. There's probably a lot of points to note there, but I guess the key takeaways are the reduced company tax rate and how that's going to apply from 1 July 2017. And further to that, some of the changes to the housing affordability, which may impact investors in the property market at the moment. So thanks for listening, and hopefully we'll see you next quarter.